So I want to expand on a topic that I was talking about in a previous video, and that is the difference between a closed contract and an open contract. So closed contracts are going to be one of the characteristics of commercial insurance companies, and open contracts are characteristic of fraternal benefit societies, fraternal benefit associations. So the main difference between the two is going to be what constitutes the entirety of the agreement. So in a closed contract, typical of commercial insurance companies like your AIGs, your Prudential, your Mass Mutuals, and the like of this, the contract, basically the entirety clause, is going to state that the clauses in the contract along with the application together constitute the entirety of the agreement. In an open contract, there's one additional element, and this is usually the charter, the bylaws, the Constitution, or whatever other controlling or founding document is relevant to the fraternal organization or society that is under consideration. So for example, with the Thrivent Company, which used to be the Lutheran Brotherhood, or with the Woodmen, or with the Knights of Columbus, what you will find is that part of the contract is going to be the bylaws, the charter, the Constitution of that fraternal benefit society. Now, in order to understand what the significance of this difference really amounts to, and in the first place, there's kind of a surface difference. First, and I should say, I'm not a lawyer. I am incompetent to provide you with legal advice. This information is merely for entertainment or general purposes only. I cannot advise you in legal matters or anything like that. But in general terms, a closed contract is going to be one where every provision is locked in place, and the contract cannot be changed except by mutual consent of the parties involved in the contract. Now, in life insurance, there can be a number of parties involved, but on the most superficial level, you're dealing with a person who's the insured and the company that is the insurance company. So the insurance company and the insured enter into an agreement, and in a closed contract, the provisions of that agreement cannot be altered except by written amendment, and that amendment would have to be signed by both parties. Now, everything is mostly the same in a fraternal agreement. In an open contract, the one difference basically is that not everything is fixed. An open contract is one where, as the name suggests, certain things are left unresolved, and there's an open nature to at least a portion of what the contract ranges over. Now, to give you a flavor of what that might be, I'm going to draw a comparison between life insurance and the banking system. So in the banking system, we have what's called a fractional reserve banking system, and that basically means, I'm going to bring it down to a very low level here and be very, very general. What that basically means is that individual banks are only going to have a portion or a fraction of the amount of money that they actually have in terms of assets under management. So if you look at a bank and you add up all of the deposits, everything that bank has, all the bank accounts, you add up all that money, it's not as if that bank has all of that money on hand. And what that basically means is that in a very extreme case, and cases like this have occurred, they're somewhat rare, but they have occurred, for example, in the Great Depression, where you have what's called a run on the bank. And what that means is that you have a critical mass of people returning to the bank and saying, I want my money back. And the bank is able to give out deposits to give you your money back up to a certain level. But since they don't have the sum total of all deposits on hand, they're going to get to a spot where if so many people come in and ask for their money back, they're not going to be able to satisfy all of those demands. So this is called a run on the bank. So what's going to happen is that local bank is going to have so many people asking for money back, that local bank is going to have to ask its regional bank, and that regional bank is going to have to ask its, so on and so forth, and each bank is going to have to go up a higher level and get more money. And the whole idea here is, in a fractional reserve banking system, the reserves that the banks have on hand are only a portion of the total amount of deposits. And so if you get enough people asking for their money back, the bank is not going to be able to provide it. Well, there's a similar thing in life insurance. And the way that basically works would be there is such a thing as a legal reserve. And this is the amount of money that an insurance company is required by law to have on hand. Sometimes companies may have more than the legal reserve, but they may not have less. And the legal reserve is going to basically be a function of the kinds of people that they have insured, the number of contracts they have, the amount of cash value that they have in whole life contracts, the amount of death benefit that they have written. It's going to be a complicated formula, but in essence, it's going to be a probability judgment. It's going to be based on the probability that any given insurance company is going to have to take a certain amount every year of cash values and surrender them. And it's going to be based on a probability judgment that a certain number of people are going to die in a given year, and that insurance company is going to have to pay out a certain benefit level in a given year. So in a similar way to how if too many people come to the bank and say, I want my money back, the bank can be in trouble. In a similar way, if more people die in a given year than the insurance company predicted, or if more people request their cash values to be surrendered, given back to them, than the insurance company predicted, then the insurance company can likewise be in trouble. Now here's the difference then between an open contract and a closed contract, at least one of the differences. And that is, in an open contract, the open contract makes a reference, again as we said, to the charter, to the Constitution, to the bylaws that were put in place when the Fraternal Society or organization was founded. And generally speaking, in those founding documents, you have provisions that allow for an increase in premium dollars, that is to say, in money that people are paying into their contracts. And the idea here is that the fraternal organizations are trying to make a provision for saving payouts in a circumstance where an insurance company has a higher mortality experience or a poor investment experience in a given year than it thought it would. So in other words, a higher mortality experience would mean more people die than they thought, and a bad investment experience would mean that the insurance companies had an investment that didn't pan out, and they ended up with less money than they thought they would. Okay. Now again, go back to the video where I talk about the difference between fraternal and commercial insurance companies, and you will discover that there are limits on the kinds of investments that any insurance company can have. They cannot have overly risky investments, but even so, even conservative investments can fail to pan out from time to time. And so the idea here is, in theory, it is possible for an insurance company to run into a circumstance when it has to pay, when it's faced with paying out more claims or cashing out more policies than it thought that it would, and then it runs into money problems. And the idea here is, how does the company fix that problem? You really have two things that are possible. The first is that you have a guarantee on the number of premiums, on the amount of premiums that people pay in. So you have a guarantee on what people pay in. But you also have a guarantee on what the insurance company promises to pay out. Ideally, you're going to want to have guarantees in both places. If I'm going to write a contract, if I'm going to take a policy out with any company, whether it's fraternal or commercial, I'm going to want to know what I need to pay into the policy, at least within a certain range, and I'm going to want to know what the company promises to pay to my beneficiaries or to me under certain circumstances. Again, at least within a certain range. But the reality is that there are cases in which certain companies are going to run into problems, and at that point, the fact that they want to guarantee both the amount of money going in and the amount of money going out, what they run into is a circumstance where one of those two guarantees is going to have to be firmer than the other. So the basic idea is, if the insurance company runs into problems, then it's either going to have to take in more money than it thought, or it's going to have to pay out less than it thought, or both. Hopefully not both. But here's the basic difference. In a fraternal contract, the fraternal contract provides that if, generally speaking, if there is a poor investment experience, or if mortality experience is worse than the company thought, that the company can then appeal to its founding documents and appeal to its membership in such a way as to say, look, we need an emergency infusion of cash because we want to preserve the benefits that we promised to people. So in a fraternal context, the idea is they hold a little bit more firmly to the guarantee on the payout. But to do that, they have to provide that they may occasionally require an emergency infusion of cash. It may be very rare, but that's the idea. On the other hand, The commercial insurance companies are basically going to say, we guarantee you we will never ask you for more money. But if push comes to shove, the basic idea is that they're going to have to reduce the amount of benefits that they provide, because the nature of their contract is that they don't have any outside agreement that they're appealing to. Their contract, remember, is closed. Everything in that contract is absolutely closed. And so what they basically tend to guarantee is that you will not have to put in more money than what is contractually required in that contract. But that means that if their investment experience turns out badly, or if their mortality experience turns out to be worse than they predicted, they may end up having to pay out fewer benefits than they thought that they would. The alternatives really here are for some court to get involved, for the company to go into receivership, for a court to basically restructure in such a way as to try to save as many of the obligations and try and pay out as many of the obligations as are possible. So the idea of these contract provisions is to try and have safety nets in place. The commercial companies, again, tend to guarantee that you're not going to have to put in more than they said, but to do that, they may have to fudge a little bit on the payout. And the fraternals want to guarantee that they're going to pay out what they said, but to do that, they may from time to time have to request a little bit more. Now, having said that, I'm not saying that this is a common occurrence, because once again, the illustration that I started with was a run on the bank. And of course, in the banking system, that sort of scenario is a Depression era level problem. So hopefully, and people predict that the market might do this or that now, but the idea is that that kind of strain on the banking system is very rare, and in a similar way, we would hope this kind of strain on the insurance system is likewise very rare. Some insurance observers, for example, Van Miller, actually suggest, based on their research, that during the Great Depression, insurance companies turned out better than many banks, and one of the reasons for that is because the insurance companies did not have their money invested in the stock market. So when the stock market collapsed, their assets were, for the most part, protected. Nevertheless, the idea here is that the difference between an insurance contract in a commercial context and in a fraternal context is the difference between its being closed in the commercial and open in the fraternal. And the basic idea here is that the open contract also makes reference to a charter, to bylaws, to a constitution, and it's open because those bylaws, that charter, can be amended, and those amendations will apply to the contracts that are in force. I know this was a bit of an abstract topic today, but if you found something of value in it, please like the video, please subscribe to the channel. I will be dealing with other content shortly, and I appreciate your support, and I look forward to seeing you in another video. Thanks a lot.